I highly recommend you to read the original book of the author. But here in this video, I've summed up my 10 takeaways and thoughts about this book so you may have a more weighted opinion about the book. Disclaimer: this video does not infringe on the copyrights of the author of the book, as this video is based on fair use doctrine and explains my own opinion about the book, and does not use any direct text from the book. Here are 10 main points from the book, Stock Investing for Dummies by Mladjenovic. 1. Investing in the stock market can be a great way to grow your wealth, but it requires patience, knowledge, and a long-term strategy. 2. Before investing in stocks, you should have a clear understanding of your financial goals, risk tolerance, and investment time horizon. 3. One of the most important factors to consider when investing in stocks is the company's financial health, including its revenue, earnings, debt, and cash flow. 4. It's important to diversify your stock portfolio to reduce risk and maximize potential returns. This can be done by investing in stocks across different sectors and industries. 5. Research is key when investing in stocks, and there are many resources available, including company financial reports, stock analysis websites, and investment newsletters. 6. You can buy stocks through a brokerage account, which allows you to buy and sell stocks on a stock exchange. 7. It's important to understand the different types of orders you can place when buying or selling stocks, including market orders, limit orders, and stop orders. 8. Stock prices can be influenced by a wide range of factors, including economic indicators, company news, and geopolitical events. 9. To be a successful stock investor, you should have a long-term mindset, be patient, and avoid making emotional decisions based on short-term fluctuations in stock prices. 10. Finally, it's important to regularly review your stock portfolio, rebalance your investments as needed, and stay up to date on market trends and news. Point 1 of Stock Investing for Dummies emphasizes that while investing in the stock market can be a great way to grow wealth, it requires patience, knowledge, and a long-term strategy. Patience is essential because investing in stocks is not a get-rich-quick scheme. Rather, it's a long-term investment strategy that requires the ability to withstand short-term fluctuations in stock prices. Investors should be prepared to hold their stocks for years or even decades to realize their full potential returns. Knowledge is also crucial because investing in stocks involves understanding financial statements, stock market trends, economic indicators, and other factors that can influence stock prices. Investors should have a solid understanding of how the stock market works and how to evaluate companies before investing in their stocks. Finally, having a long-term strategy is important because trying to time the market or make short-term trades based on daily fluctuations can be risky and lead to poor investment decisions. Instead, investors should focus on creating a diversified portfolio of quality stocks and holding them for the long term, allowing time and compounding to work in their favor. Overall, point 1 highlights the importance of having the right mindset, knowledge, and strategy when investing in stocks. Point 2 of Stock Investing for Dummies emphasizes the importance of having a clear understanding of your financial goals, risk tolerance, and investment time horizon before investing in stocks. Your financial goals should be specific, measurable, and realistic. For example, you might want to save for a down payment on a house, pay for your child's college education, or build a retirement nest egg. Your financial goals will help determine how much money you need to invest and how long you need to invest it for. Your risk tolerance is your ability to withstand fluctuations in the stock market without getting too nervous or making hasty decisions. Some people are comfortable with high-risk investments that offer the potential for high returns, while others prefer lower-risk investments with more predictable returns. Understanding your risk tolerance can help you choose the right mix of stocks and other investments for your portfolio. Finally, your investment time horizon is the length of time you plan to hold your investments. This can range from a few years to several decades, depending on your financial goals and life stage. A longer time horizon typically allows for more aggressive investing strategies, while a shorter time horizon may require more conservative strategies to protect your investments from short-term market volatility. Overall, understanding your financial goals, risk tolerance, and investment time horizon is critical when investing in stocks because it helps you make informed decisions and create a portfolio that aligns with your needs and preferences. Point 3 of Stock Investing for Dummies highlights the importance of evaluating a company's financial health before investing in its stock. When evaluating a company's financial health, there are several key factors to consider, including 1. Revenue, the amount of money a company generates from its products or services. 2. Earnings, the profits a company earns after all expenses have been paid. 3. Debt, the amount of money a company owes to creditors. 4. Cash flow, the amount of cash a company generates from its operations. By analyzing a company's financial statements, investors can gain a better understanding of its financial health and potential for growth. For example, a company with high revenue and earnings growth, low debt levels, and strong cash flow may be a good investment opportunity. It's also important to consider the industry and market trends that could impact a company's financial health. For example, a company in a rapidly growing industry may have more potential for growth than a company in a stagnant industry. Overall, evaluating a company's financial health is a critical step in deciding whether to invest in its stock. By doing so, investors can make informed decisions and choose stocks that align with their investment goals and risk tolerance. Point 4 of Stock Investing for Dummies emphasizes the importance of diversifying your stock portfolio to reduce risk and maximize potential returns. Diversification means spreading your investments across different stocks, sectors, and industries. By doing so, you reduce the risk of having too much exposure to any one stock or industry. For example, if you only invest in tech stocks and the tech industry experiences a downturn, your entire portfolio could be at risk. However, if you invest in stocks from multiple industries such as healthcare, finance, and energy, you reduce the impact of any one industry on your portfolio. Diversification can also help maximize potential returns. By investing in a variety of stocks, you increase your chances of owning some of the top-performing stocks. This can help offset any losses from underperforming stocks. There are several ways to diversify your stock portfolio. One way is to invest in stocks across different sectors and industries. Another way is to invest in stocks of different sizes, such as large cap, mid cap, and small cap stocks. Additionally, you can diversify your portfolio by investing in stocks from different geographic regions or countries. Overall, diversification is an important strategy for investors to reduce risk and maximize potential returns. By creating a well-diversified stock portfolio, investors can achieve a balance between risk and reward that aligns with their financial goals and risk tolerance. Point 5 of Stock Investing for Dummies emphasizes the importance of using fundamental analysis to evaluate stocks before investing. Fundamental analysis involves analyzing a company's financial statements, management team, industry trends, and other factors that can impact its financial health and future growth prospects. This analysis can help investors determine whether a stock is undervalued or overvalued and make informed investment decisions. There are several key metrics that investors can use to evaluate a company's financial health, including 1. Price-to-earnings ratio, P/E ratio, the ratio of a company's stock price to its earnings per share. A high P/E ratio suggests that a company's stock may be overvalued, while a low P/E ratio may indicate that it is undervalued. 2. Price-to-sales ratio, P/S ratio, the ratio of a company's stock price to its revenue per share. A low P/S ratio can indicate that a company's stock may be undervalued. 3. Debt-to-equity ratio, the ratio of a company's total debt to its total equity. A high debt-to-equity ratio suggests that a company may be taking on too much debt, which could be a red flag for investors. 4. Return on equity, ROE, the amount of net income a company generates relative to its shareholder equity. A high ROE suggests that a company is effectively using its shareholders' capital to generate profits. By using fundamental analysis to evaluate stocks, investors can gain a deeper understanding of the underlying factors that can impact a company's financial health and future growth prospects. This can help investors make informed investment decisions and choose stocks that align with their financial goals and risk tolerance. Point 6 of Stock Investing for Dummies emphasizes the importance of using technical analysis to evaluate stocks before investing. Technical analysis involves analyzing a stock's price and volume data to identify patterns and trends that can be used to predict future price movements. This analysis can help investors determine when to buy or sell a stock based on its price and trading volume. There are several key technical indicators that investors can use to analyze stocks, including 1. Moving averages. A moving average is a line that tracks the average price of a stock over a certain period of time, such as 50 days or 200 days. By comparing the current price of a stock to its moving average, investors can identify whether the stock is trending up or down. 2. Relative Strength Index. RSI. The RSI is a momentum indicator that measures the strength of a stock's price movements. A high RSI suggests that a stock is overbought, while a low RSI suggests that it is oversold. 3. Bollinger Bands. Bollinger Bands are a set of lines that represent a stock's price movements within a certain range of standard deviations. By analyzing the position of a stock's price relative to its Bollinger Bands, investors can identify whether the stock is overbought or oversold. 4. Volume. Volume is the number of shares traded in a stock over a certain period of time. By analyzing changes in a stock's trading volume, investors can identify trends in investor sentiment and predict future price movements. By using technical analysis to evaluate stocks, investors can gain insights into a stock's price movements and identify potential buying or selling opportunities. However, it's important to remember that technical analysis is not a foolproof method of predicting stock prices and should be used in conjunction with other forms of analysis, such as fundamental analysis. Point 7 of Stock Investing for Dummies emphasizes the importance of having a long-term investment strategy and avoiding emotional decision-making. One of the key principles of successful investing is to have a long-term investment horizon. This means investing in stocks with the expectation of holding them for several years or even decades, rather than trying to make short-term profits by trading in and out of stocks. Having a long-term investment strategy can help investors ride out market fluctuations and take advantage of the long-term growth potential of stocks. It also allows investors to avoid the temptation to make emotional decisions based on short-term market movements, which can often lead to buying high and selling low. In addition to having a long-term investment strategy, it's important to avoid emotional decision-making when it comes to investing. Emotions such as fear, greed, and panic can lead investors to make irrational decisions that can harm their investment returns. To avoid emotional decision-making, investors should focus on their long-term investment goals and develop a disciplined approach to investing. This may involve setting clear investment objectives, creating a diversified portfolio, and regularly reviewing and rebalancing their portfolio to ensure it remains aligned with their goals and risk tolerance. By having a long-term investment strategy and avoiding emotional decision-making, investors can stay focused on their investment goals and increase their chances of achieving long-term investment success. Point 8 of Stock Investing for Dummies emphasizes the importance of diversification in investing. Diversification is the practice of investing in a variety of different stocks, bonds, and other assets in order to reduce the overall risk of an investment portfolio. By diversifying their portfolio, investors can spread their risk across different companies, industries, and asset classes, which can help to minimize the impact of any one investment performing poorly. There are several ways to achieve diversification, including 1. Investing in different industries. By investing in a variety of industries, investors can reduce their exposure to any one industry or sector that may be experiencing difficulties. 2. Investing in different asset classes. In addition to stocks, investors can diversify their portfolio by investing in bonds, real estate, commodities, or other assets. 3. Investing in different geographic regions. By investing in stocks and other assets in different countries or regions, investors can reduce their exposure to any one country's political or economic risks. 4. Investing in index funds or ETFs. Index funds and exchange-traded funds, ETFs, provide investors with exposure to a diversified portfolio of stocks or other assets, making it easy for investors to achieve diversification without having to buy and manage individual stocks or assets. By diversifying their portfolio, investors can reduce their overall risk while still achieving their investment goals. However, it's important to remember that diversification does not guarantee a profit or protect against loss in a declining market, and that investors should still carefully evaluate their investment choices and risks. Point 9 of Stock Investing for Dummies emphasizes the importance of understanding and managing investment risks. Every investment carries some level of risk, and it's important for investors to understand and manage these risks in order to make informed investment decisions. There are several types of investment risks, including 1. Market risk, the risk that the overall stock market or a specific segment of the market will decline, causing the value of an investment to decrease. 2. Company risk, the risk that a specific company will experience financial difficulties or other problems that could impact its stock price. 3. Interest rate risk, the risk that changes in interest rates will impact the value of an investment, such as a bond or other fixed income security. 4. Inflation risk, the risk that inflation will erode the purchasing power of an investment over time. 5. Liquidity risk, the risk that an investor will not be able to sell an investment when they want to, or at a price they are happy with. To manage these risks, investors should carefully evaluate each investment opportunity and consider their own investment objectives, risk tolerance, and time horizon. This may involve conducting thorough research on individual companies or industries, diversifying their portfolio, and regularly monitoring and adjusting their investments to ensure they remain aligned with their goals and risk tolerance. Investors should also be aware of the potential impact of taxes on their investments and take steps to minimize their tax liabilities through strategies such as tax-efficient investing and tax loss harvesting. By understanding and managing investment risks, investors can make informed investment decisions and increase their chances of achieving long-term investment success. Point 10 of Stock Investing for Dummies emphasizes the importance of staying informed and educated about investing. The world of investing is constantly changing, with new technologies, economic trends, and investment products emerging all the time. To be a successful investor, it's important to stay informed and educated about these changes and how they may impact investment opportunities and risks. There are several ways to stay informed and educated about investing, including 1. Reading financial news and analysis. Investors can stay up to date on market trends and investment opportunities by reading financial news and analysis from reputable sources. 2. Attending investment seminars and workshops. Investment seminars and workshops can provide investors with valuable insights and strategies from experienced investment professionals. 3. Joining investment clubs. Investment clubs allow investors to network with other investors and share investment ideas and strategies. 4. Working with a financial advisor. A financial advisor can provide personalized advice and guidance on investment opportunities and risks based on an investor's individual goals, risk tolerance, and time horizon. 5. Continuing education. Investors can continue to improve their investing knowledge and skills by taking courses or earning professional certifications in finance or investing. By staying informed and educated about investing, investors can make informed investment decisions and adapt to changing market conditions over time, increasing their chances of achieving long-term investment success. Thank you for your interest in this book. I would much appreciate it if you leave your feedback on this book in the comments below, or just put a like on this video. It will help me stay motivated and make more videos like this. You can find links in the description of this video, where you can purchase and download this book.